Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to try and get you guys what you need to know before you roll, and that's going to start out with talking about the economic data, see how that impacts the overall markets with a little market analysis, maybe sprinkle in some geopolitical fodder to round off that market analysis, and then finally talk about some option strategies we could look at to implement into our portfolios. All right, so without further ado, let's get on with it. The economic data coming in today, we had the numbers coming in for consumer price index. All right, this is what we're looking for. This is to tell us whether or not the producer is passing on higher prices to the consumer. And we're actually starting to see that when we strip out food and energy, which is some of the more volatile aspects of this, to try and really get down to see if we're seeing transitory inflation or real inflation kind of getting sticky. Well, the core, when you strip out the food and energy, which could be more transitory, comes in higher at 0.6%, expected to be 0.4%. Then we got the consumer price index with the food and energy added back in there, and we got the 0.3%, expected to be 0.2%. So what does that all say, folks? It really is telling us that inflation is here. As a matter of fact, a lot of it, though, is around food, the food and energy aspect, and more specifically, the energy aspect. That is up almost 40+% year over year on the 12-month expectations for just energy, folks. And then some of the other ones that are driving this is the used cars. We know that used cars prices are up dramatically. We have started to see those come off just a little bit here in the last couple of months. So we are seeing, while we are seeing higher inflation across the board here, we are seeing a downtick. And that's something a lot of people are going to try and hang their hat on here, is that we've been seeing incremental increases in these economic data points for inflation, but we just recently saw these downtick, just albeit a little bit. As a matter of fact, year over year, if we start taking a look at the consumer price index year over year, we see that that number is jacking up. As a matter of fact, it came in at 8.3%, but this is one of those data points that everybody's talking about coming off of the 8.5% high, where that was an incremental increase higher. And we could say that across the board on almost all of these data points related to the consumer price index and the inflation around that. While we are seeing historical highs here, a lot of folks are going to be talking about the downtick from this. Have we seen that high? Well, I'll have to tell you that the equity markets really aren't holding that as a feather in their cap right now. So let's take a look at the overall markets, because that's pretty much it for the interest rate, or sorry, the consumer price index. Sorry about that. Trying to think of a couple of other things. Oh, consumer credit. That was another thing that came in with this economic data point, folks. Consumer credit is starting to ratchet up here. Think about folks are used to being able to buy pretty much what they want. And now with this inflation jacking up, those products that they are more accustomed to buying, well, they're a little bit more expensive right now. They're buying on credit, and that could lead to some major problems down the road if folks are borrowing now in a higher interest rate environment. So with that said, we are seeing some movement here in crude oil. I don't think that that's really related to the economic data points here so much. It's really ahead of the crude oil inventory numbers that we'll be getting a little bit later on this afternoon here, or a little bit later on this morning. All right, bonds, finding a little bit of a top here. Any upward momentum in the bonds, folks, is an opportunity to sell into that. We know that the Fed is going to continue to increase interest rates, try and calm down some of this higher consumer price index, the overall prices across the board, the inflation. That's why they're trying to ratchet up the interest rates. Well, if they're going to ratchet up the interest rates, they are inversely related to the overall bonds here. So let me try and find my bond chart again real quick, just to give you a real quick drawing to help you with visually seeing how this overall market action works here with the consumer price index here, or sorry, with the, I guess I'm not going to be able to find my pen. Where is it? I don't know, somewhere it disappeared. Anyway, it's not going to let me draw, I guess. Maybe it will. No. Anyway, as interest rates or price goes down, interest rates are inversely related, so they're going up. Sorry if I'll figure out my pen here in a little bit. Somehow it got closed. So interest rates are on the rise. Fed is going to continue to push that. That means bond prices have to go down. So covered calls in a situation like that would be optimal. Gold futures, really surprising. They're not holding a lot of weight here with the inflationary aspect. Remember, it's tied to the dollar. So any type of inflation should drive gold prices higher. Bitcoin, if it is the holder of value or a retainer of value, we would also expect to see that. It's really not something that people are considering a flight to safety. So that's why we're seeing that continue to sell off as well. If you have an NVIDIA, it is running in tandem with what Bitcoin is doing. So they are directly correlated. Now, we've touched on a couple of these spots that we've been looking for here. The pandemic high here, and now we're looking at 11,250 for a mark. Now, I don't know that we're necessarily going to get down that far, folks. I don't know that we are in a position to really start seeing that far out and start pricing that in pre-pandemic. I just think that that's a little too much. I think we'll find a little consolidation around this area before we start really seeing exacerbated moves to the downside. There's still a lot of worry around the globe about inflation, about growth going forward. So while we have gotten to a place here where it probably should be a bit of a pause, we're at an extreme low level here. We've put the thumb screws on anybody that's got weak hands. That's usually a pretty good recipe for a bottom there, where you get the weak hands to shake out. Have we gotten there? We haven't seen the market action to really tell us that we found that bottom just yet. So I would not be jumping on board just yet. Volatility continues to drive higher. That means prices in the options continue to move higher as well. On a directional down move, that's a difficult one when we are at these types of levels to start playing around with. So I'm going to wait for a bit of a settling down, maybe another incremental move down, find the next Fibonacci levels there, which are not too far away, folks. We've seen the pandemic high in the NASDAQ, not quite so much here in the E-mini S&Ps, the Dow Jones Industrial Average. Why? Well, they're going to have a less aggressive move to the downside, because especially the Dow Jones is where folks are going to be parking their money. Now, this week I've been trying to figure out, hey, if they're pulling money out of the NASDAQ, they're not putting money into gold as a retainer of value. Well, where are they putting that money? Well, the most likely place right now is going to be in blue chips, things that have had lower multiples than, let's say, the tech sector and things like that. So when we're seeing these lower multiples, that is an opportunity to start adding something to our portfolios. And a lot of folks starting to worry about that place to go, things that are in the in the Dow Jones Industrial Average. We get over to the E-mini S&Ps. This is going to give us a really good snapshot look at what happened since the markets open. Now, yesterday we did get a bit of a pausing pattern. Some people might look at it as a bottoming. I think that it is a continuation here. And with the economic data point on this consumer price index, albeit it did come in lower than what was expected here, folks, it really is starting to show that we could be seeing this inflation as more of a stay than as a transitory type of thing. We're seeing it with wage inflation. That was up, I think, 11% or so. Well, those wages are very difficult to cut back, right? The only way that you usually see lower jobs is after a big firing across the major economies and people getting laid off as a recession type of situation to reset some of those higher prices there. And that's about it, folks. I haven't really found anything. Like I said, I'm not going to jump in. I'm not going to go in head first. I'm going to be testing the waters here before I start jumping in, especially with the market action. Something that might be a positive to the economy, just not getting the market reactions. We've seen where inflation may be rolling over a little bit. That could have been at least something bullish to kind of break us out of this pattern here, not really happening. You can see we're just seeing a new low there in the E-mini S&Ps. Pretty bearish market action. We're going to need to see some real geopolitical fodder to turn this market around. All right. So otherwise, I would say to the downside, anytime we're getting these rips, that's the opportunity to sell those calls still. All right. We talk about that in the webinars that we do on Thursday. Tomorrow, we're going to be doing one on the short put spread. We can use this to take advantage of this market sell off, the high volatility, and an opportunity to find that bottom, maybe even add something to our portfolio for a directional positive move. All right, that's all I got. I'll talk about those details tomorrow and show you how to really crack the code to trading options. All right, if you can't take that, take it easy. And another down tick. Bye for now. Good luck trading.